You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
Okay, good evening. On behalf of the Harvard Business School Club of New York, a warm welcome to everyone for tonight's session. And the session is how all investors can use options to tune turbulent markets. I'm Gary Kreisman. I'm an HBS alumni, and I'm a volunteer for the Harvard Business School Club of New York. Let me just say a few words about the club, and then I'll introduce our panelists. Our club is the largest HBS alumni organization in the world. We have over 10,000 graduates in the New York area. The mission is to make a difference by engaging alumni, impacting the community, fostering leadership, and lifelong learning. And one of the ways we do this is we organize over 100 content-rich events every year. Based on what happened with COVID, we've ended up going from live events to virtual events. And so we ask you to bear with us in yet another Zoom. This brings us to tonight's conversation. I'm going to lead this discussion for approximately 40 minutes. We'll ask a series of questions, and then we're going to open it up to the audience for the last 20. I'd ask any of you who have a question to submit it in the Q&A section at the bottom of your screen. We'll do our best to get to all of them by the end of the session. And at the end of this, there'll be a quick 1-minute evaluation that'll be delivered to your browser via Zoom. Please fill that out. It always helps us in planning further events. We're going to start with a quick poll that I'll ask Liz to put up, just asking you about your experience in trading options. So if you'd be so kind, just answer that one question for us. Results coming in fast and furious. Okay. Got about 25 responses here. So it's nicely proportioned. About half the people who have responded to this question have traded options before, and they've made money. So congratulations, you've come to a good place. And now, the opportunity now, of course, is to do even better, and that's what our experts will help you. About a quarter of the people said, yeah, I've traded, but I lost money. You have our sympathies, but you'll also get some advice here that may be helpful to you. And about a quarter of this group has not traded before. So that's very helpful, really, in understanding the extent to which the audience needs basics as well as some of the specific trading tools and ideas that Mark, JJ, and Dan will talk about. So let me just begin with this. I think as investors, we're all well aware of the volatilities everywhere and the aggressive Fed tightening, going in and out of a bear market. exchange rate issues, the end of the 60-40 portfolio, on and on. And if you're an investor who's looking for income or steady appreciation, or at least some shelter from the storm, what are you supposed to do? The stand back and wait approach could work, but it may take many years. Buying the dips, good luck with that. And this is why we're here today. Working with basic option strategies can provide solid returns and hedges against disaster in any market. And many feel that these things are necessary. To be clear, our panel is not going to be talking about speculation. They're going to give you some solid ideas on how to use options as tools to achieve realistic investment objectives. So let's get started. I'm going to begin by introducing our panel and then let them tell you a bit about themselves and about their involvement in options. So let's begin with JJ Kinahan. JJ is the CEO of IG North America, a leading firm in derivatives, options, as well as foreign exchange. And he's a board member of the CBOE, which is the leading options exchange. Mark Longo is the voice of options via streaming audio. Mark founded and runs the Options Insider, which has many channels of options information, both for experts and investors who are newer to the space. And Dan Passarelli heads Market Taker and is a top educator on all things options. Dan has a wonderful ability to simplify the complexities and a great practical sense of how to help investors use options to meet their needs. So it's a panel that knows what they're talking about. It's a group that the group of you in the audience have a good understanding, I think, for the most part, of what options are about. So we're going to take a view starting with some of the basics. I'm going to ask each of the panelists to provide some kind of response to each of the first few questions, and then we'll get into more back and forth from there. So let's just start with a simple question. Do you feel that options are right for typical investors who are seeking income, capital preservation, or growth in income? And Dan, let me start with you.
Sure. Thanks, Gary. So my short answer is yes, they are. Professional traders use options for all those things. And because we're talking about listed options, which are, very standardized options that trade on an exchange that are accessible to everyone, options level the playing field among the professional trader on Wall Street to just the regular Joe who has a very small portfolio, but also wants to be able to grow it at a faster rate, or to be able to protect him or herself, or to be able to handle when markets, are either heading lower or getting more volatile, which lately we've been experiencing both. So yeah, I think that they can play a really, really important role for a typical investor.
Okay. JJ, anything to add on that one?
Yeah, well, first of all, Gary, thank you to you and Elizabeth and HBS for having us. Much appreciated. But I think absolutely, and you talked about income enhancement, et cetera. I think one of the great things about options is that you can define your risk in a much better way, in my opinion, than you can with any other instrument as you get more advanced in spreads, et cetera. The starting for most people is just a covered call. That is writing an out of the money call against stock they're already long to get some income enhancement. Now they may be giving up some upside for that. It gives them a little bit of risk, but I wouldn't a little bit of risk protection. Should say I wouldn't consider writing a covered call truly risk protection. I think for most people it's more about a little bit of income enhancement. That said, that's usually, as I said, the starting point traditionally for most people getting started in options. But I can't stress to your audience enough. I think I think one of the things that people don't spend enough time doing on any one of their investments is defining what their own personal risk is. We always hear about don't be emotional. It's money. Everybody's emotional. But the thing to do is to say, okay, what can I reasonably lose, or what am I comfortable with my risk? Then what can I reasonably make to take that risk on? And no matter what investment you're going to make, please start there. Unfortunately, too many people are like, look what I can make. I think if you ask Dan, Mark, or I, we usually start our investments with, what's my reasonable risk here? Now, what can I make to pay for that?
Very good. Mark, let me ask your view on this too, but I'd also, it occurs to me that we have some people who haven't traded before. Maybe we want to start with the definition of some of the techniques that Dan and JJ have already mentioned.
Sure, we can do that. Well, welcome, everyone. Good to talk to everyone here virtually, of course. Yeah, it's an interesting time to be talking about options, coming off the tail end of a record year last year. Everyone was, for the most part, stuck at home, and trading became the national pastime. So we saw record volume, just about 10 billion contracts going up in the options market last year, which is pretty much more than double what it was the year before. And of course, a record number of people participating. I'm sure JJ can speak to that as well in terms of clients coming in, new people discovering the world of options all the time out there. So from a perspective, not just from a market valuation and where we are right now in the market's perspective, it's a good time, but also just from a fact that options have never been as popular as they are right now. So this is a great time to be dipping your toes in the options waters out there. And yes, there are a lot of different use cases for options. Dan and JJ hit on a bunch of them. They pretty much, no matter what your use case is, no matter what you're trying to accomplish, whether it's income, whether you want to be a little bit more speculative, a little bit more risky, whether you want to dial back the risk and be a hedger, no matter what you want to do out there in the market, there is an option strategy. There is an options use case for you. Gary mentioned income. JJ mentioned the covered call. So maybe we'll start there. I noticed half of the audience has pretty much a little bit of some experience, some expertise in options. I would go out on a limb if I had to guess what your first starter trade was. I think for a lot of you, it probably was this. It probably was the covered call. So let's walk you through an example right now. Everyone's favorite, XYZ, right? We've all made and lost fortunes on XYZ, especially Dan. He's down a lot on XYZ right now. He needs to make it back. But let's say at XYZ, you come in, it's trading for $100. And you're long 1,000 shares. So it's a pretty substantial portfolio. You're talking $100,000 worth of equity in this name. Now you're sitting on this position. You're saying, what can I do with this? Maybe you think it's going to languish for the next few months and not really do much. So what can you do in that environment? Well, a couple of things. You could sell your stock and wash your hands of it, take whatever profits you may have and move on to another trade. That's certainly an option. Pun intended. You could do what a lot of people tend to do in markets like this, in a situation like this, which is they just wait. They turn it into a long-term hold and they just see what happens and they hope for the best. And we're going to try to maybe edge you away from that and into option 3 here, pun intended, which is to generate that income stream we were just talking about, which is selling a covered call. Now, in this case, you have to do a little bit of homework. You have to do a little bit of analysis for yourself. You have to be honest with yourself in this analysis. You have to say to yourself, where do I feel comfortable selling this stock, let's say, within the next month? What level does it get to you that I will say, okay, I'm comfortable selling it? In our example, our customer here decides they're comfortable selling XYZ if it gets to 110 in the next month. And so that's a nice little 10% return. Who could blame them out there? And so in our example, they decide to sell a covered call that's on the 110 strike. Of course, the strike is the options price, where if you exercise that contract, that is where you will buy or sell the underlying stock. In this case, it is on the 110 strike. And in our example, that 110 call option, it is only 1 month, is trading for $1. Nice and easy. Nice and easy. Now remember, these are equity options. So every one equity option is for 100 shares of the underlying stock. So you have to multiply that times 100. So if this is a $1 option, you have to multiply that times 100. So that gives you 100, obviously. And then we need to do 10 because we want to do 1,000 shares, cover all income for all of your 1,000 shares. So 1 times 100 times 10 is, of course, $1,000. So you've just collected $1,000 in income in our example, or 1% of the value of that option. And now a couple of things could happen. If the underlying goes above 110, expires above 110 over the course of the next month, then of course you will sell that stock at 110 plus the $1 that you collected. So the effective price of 111. And if it drops, as JJ was alluding to earlier, if it goes down to, let's say, 95, you still have that $1 worth of income that you collected. No one takes that from you. No, that doesn't go away. And then of course you could see over time how just repeating this example over and over again, if the stock decides let's say, languish throughout the rest of the year, if you can do somewhere around 1% or more a month just in income, in our example, you can see how over time that would be tremendously additive to your portfolio. And Gary, I'll open it up from there.
Okay, thanks, Mark. And I think you've given a good example of what the ongoing process would be in working with covered calls. But let me ask you guys this. Are the techniques that you're talking about right for investors who are convinced the market is going lower? You know, we've been in a bear market in and out for the last few months. There's a lot of negative sentiment. Interest rates keep going up. If you believe that, are there techniques that you would recommend that that would be appropriate to protect your portfolio or even take advantage? And I'll start with JJ on this one.
Sure, Gary. There's quite a few things you can do. Actually, I'll start with some simple things. And I guess the first question, when people review their portfolios, one of the things you should ask yourself is, if I think a stock's really going lower, why am I long it? Why wouldn't I sell at least some of it and, try and buy it back a bit lower? So I think that's the first honest question you have to ask yourself. We really think we're going lower. Secondly, you can buy puts. So for those of you who may be a little bit older, the easiest way to remember with calls and puts when you buy is the old phone. When you call, you want us to go up. When you put down. So when you buy a put, you'd like to see the market go down. So what you can do is buy puts if you want to do so in a particular name. If you want to do so, like an ETF that represents an index, QQQ or Spider or something like that. Or you can go to the SPX, which is a much bigger product and probably not a place to start for most people. It's more of a place to graduate to. But there are a number of strategies you can use as for most folks on here, if you're newer, and I know about half of you have never traded options before, probably want to look into covered calls and cash covered puts. For those of you who start to become a little bit more experienced, I would truly recommend you learn vertical spreads and calendar spreads. If you understand all four of those, there's nothing in options you can't understand, because they're all some sort of combination of all of that. So getting back to I want to keep the examples simple. We only have 40 minutes and I don't want to confuse people. But by buying a put is the simplest way to take advantage of downside in the market overall.
Great. Dan, anything to add on that one?
Yeah, I would like to take that even a step further. So JJ gave an amazing explanation about, like, if you want the stock or the market to go down or a stock to go down, you think it's going to go down, you would buy a put because you make money when the stock goes down. So
I think Dan is first.
I think it's Dan, yes. If you want, Gary, I can jump in while we're waiting for Dan.
I like the image.
It was nice. It was nice to just freeze him momentarily there.
You going to answer the question, Mark?
Yeah, sure. I'll dive into
Mark,
it. Sure.
Why don't you go for it?
Sure. So Dan was about to talk about puts. JJ was talking about long puts. He got into calendars, all sorts of fun stuff too. Maybe we'll have time to get into that a little bit later. The 201 to 301 kind of stuff. But let's flip the script around. We were talking about selling calls before. Let's do a quick example of a long put for those of you who haven't done that yet as well. Go back to our same favorite name, XYZ. Again, the one. That's why Dan had to hop off. He's losing money as we speak on XYZ. Once again, trading at 100. You're concerned about downsides. I think JJ's point is a valid one. If you're concerned about downside, maybe it is time to pare some of those holdings down there. But for whatever reason, maybe you can't sell it. Maybe there are tax issues, or for whatever reason, you cannot divest some or all of this holding. Then there's other things you can do. Of course, there's the tried and true strategy of wait and hope for the best. But in our example, we're going to walk you through using a put to hedge in this example. And it's the same scenario. We're going to walk out, and I ran the numbers up before this. These are actually pretty cheap by comparison compared to what these puts are actually trading for in the market right now. But in our example, let's say you're concerned over the next month, if it drops to $90, so 10%, you say, that's it, I'm out, I'm done, I can't take the heat anymore. So in our example, you buy a 1 month, so it expires in 1 month, A 90 strike put that effectively stops you out at $90. Now, in our example, you pay $1 for it. So it's just like the other example. The 110 call was $1. The 90 put is $1 in our example here as well. So you now, first off, you're paying obviously 1% of the value of that portfolio. And trust me, that's low, but 1% of the value of that holding to hedge it. And also it's costing you $1. So you have to add that into your strike. So effectively now you are stopping yourself out at an effective price of $89. And now remember, same thing. Equity options, they have a multiplier of 100. So in this case, you have same position, 1,000 shares you're worried about. You have to hedge. So you have to do 10 contracts, 10 times 100, of course, 1,000 times $1. That's $1,000 that's going to cost you for this put. Now, obviously your first response might be, wow, that's expensive. And you would not be wrong. It is expensive. And we could explore some ways to mitigate that cost in a bit. But what have you done now? For the next month, no matter what happens, if the market falls out of bed and or in this case, XYZ, let's say it goes to 50. Well, you know what? You're stopped out. If it happens overnight, people worry about gap risk all the time. That's where a put is tremendously effective. If the market gaps down and it opens up much lower than where it was, if you have stop orders in there, you could get triggered on those. Whereas in this case with the put, you're stopped out. You're stopped out at the effective strike price of $89, and none of that will ever change for the lifetime of that option. I think Dan is back now. Dan, anything you want to add on all things put, sir?
Well, it sounds like you covered it, Mark, and thanks for covering for me.
Got to pay that internet bill down there in the hinterland, sir.
Yeah, I had to go ask the hamsters to run around the wheel a little faster. They're good now.
So as a follow-up to what you were describing, what's the best piece of advice you might offer to an investor without options experience who wants to get started in what they consider to be a market with negative bias? What would you say to them, do first or do stepwise? And anybody pick it up.
Yeah, I can jump in, internet willing. So options really are a very, very powerful tool. And just like any other powerful tool, it's required that you treat them with the necessary respect, right? Like I wouldn't, have someone who'd never driven a car. I wouldn't give them my car keys, or anything like that. So step one is to learn. Go figure. Get down the basics, and we can get some practice. There are many, many trading platforms out there that will actually allow you to trade with fake money, to try out the things that you learned. And I feel like there's a few different iterations when it comes down the learning path, right? So first we learn, and then we start practicing with fake money, right? And what we figure out at that point is that, things don't actually work exactly like they do in the textbooks. And so we kind of get our sea legs with that. But then when we start trading with real money, we always want to start really small, because guess what? The market, when you have emotions and when you have, your real money at stake, the market can act a little bit different, because, the platform that has, that's designed to trade with fake money, they try and recreate reality as well as they can, but it's not perfect. So that functions a little bit differently. But what else functions a little bit differently is your emotional responses to things, how you think under pressure, right? So we always want to start really small and then expand from there. And I've seen many people follow that route and end up being really, really successful, both as active traders, but also as investors. To use this powerful tool, it's a great tool to use, and take your time, take it slow, and put in some time at it.
If I can jump on Dan on that, Danny, I'm glad you started with starting small with real money. In paper money, I could lose $50,000 and I wouldn't flinch. In real life, if I lose $20, I hate everyone I ever met. So it's, and I think Dan's 100% right. the truly best way to learn is once you start making a trade. So do it as small as possible, because you'll have enough, even though it may only be $100, as in Mark's example earlier, that you're risking, et cetera. You are going to have enough pain and suffering in that $100 because you're going to focus on nothing else. And that's okay, because that's how you start learning. And the easiest thing in the world is to become a bigger trader. The hardest thing, and to become a bigger investor, to whatever it may be, as you start having success. The hardest thing in the world is to, lose some money, because people's natural reaction is they often tend to start too big. And then they lose a little money. So what do they say? Well, I was doing 5 before. I'm going to do 10 and make it back. And so it's really the worst case scenario. And that's how people chop themselves up. I would say, I run a brokerage firm. I shouldn't say this, but I truly mean it. Stay small for a long period of time, because once you get good at it, it's like, and you're learning a skill. And I think people actually don't look at investing as a skill. And I find it, very odd that if you were going to learn how to play piano, you wouldn't the first day try and, play a concert. You'd be a chopsticks. And I think that you have to look at investing a little bit the same way. Start small. You'll get there, but getting good habits, starting to understand risk is really, once you do that, once you get in good habits, the making of money actually takes care of itself. It really does. And I know that sounds funny, but once you learn how to stop losing money, making money takes care of itself. And by the way, most professional traders do lose money on 30% or so of their trades. The difference is they've defined their risk. They get out. They don't say this time is different. Mm-hmm. Hope is not a strategy. The only thing that's ever different, by the way, is it'll be the most money you ever lost. And so I just think some of the common sense things that you hear, really, if you're going to be successful long-term trading, that's really what it's all about, is really taking that common sense and applying it. And by the way, discipline is difficult. If it wasn't, I could walk past Oreo cookies without getting 20 of them. But you have to be disciplined, and you have to decide where you're going to be disciplined in life. And being disciplined in your investing, I think, is a skill that I've been fortunate enough to learn. And I think that that's one people want to develop for their whole life.
So, JJ, following up on that, because I think that's good counsel for any kind of investing. Do you feel that once you've learned the skill of, let's say, doing covered calls or cash secured puts, that it becomes less of an emotional issue, that you kind of have muscle memory? Do you guys generally agree with that?
100%, Gary. I think you just look at the situation and you tend to say, okay, again, you assess your risk right away. And you say, okay, does this trade make sense with what I think I can get in reward? So for me, at least, it helps to, don't get me wrong, as I said, to every single day if you have a bad day, even a small amount of money lost, I'm angry at myself. But that being said, the muscle memory does help overall. And it's really just about developing good habits, because once you develop those habits, to your point, I think muscle memory is the perfect way to say it.
Yep. I want to go back to do another quick poll question. Liz, if you could put that up. What we're trying to find out here is, for those of you who've had trading experience, which of these techniques have you done? And just curious to see what that result is.
Maybe, Gary, while you're doing that, I'll hop in on the bear market strategies here, because I agree completely with what JJ and Dan were saying. That was the first thing I thought of when you asked this question, was keep it simple, keep it small. In these markets, if you're just starting out, keep it small. I think Dan's suggestion of paper trading is great. We just had a listener write in today and tell me how he's paper trading with a whole $100,000 on a certain account, and he lost a bunch of money, but he's learning a lot from it. So it's a great way to learn when it's fake money out there. But Gary also mentioned a specific strategy, the cash secured put. I thought we give you a little bit of specifics to take away from this conversation as well while you guys are filling out the poll here. Because you might have thought the last example I gave you, you're buying a put, and you're like, wow, that's kind of pricey. What else can I do? One of the things we've seen a lot of in this market is very much the polar opposite of last year, right? Last year was the meme stock palooza. So everyone and their mother and their grandmother's mother were all out there buying calls on every hot meme stock they could. So a lot of the hot flow out there was all in the calls. This year, we've been trending lower in a lot of the major indices and a lot of the hot names you watch. So it's been mostly in the puts. And so that's where a lot of the interest, a lot of the action has been. And we've seen a lot of people starting, and it could be depending on the names you're looking at and the levels you're looking at, starting to find levels where they think, you know what? I am comfortable perhaps buying a particular equity. Could be an individual equity, could be an ETF, could be an index. And I'm identifying levels where they would be comfortable buying that. And then doing what Gary mentioned, the cash secured put strategy. Let's go back to XYZ really quickly while you're filling out the poll here. And again, it's trading at $100. And maybe in this scenario, you're not long it, but you're kind of intrigued by XYZ. You're saying, I don't really like it here at 100, but if it drops some more, maybe let's say 10%, I might be inclined to start nibbling there. And that's where something like the cash secured put comes in. Take everything we talked about before and just flip it around. So now we get down to 90. In this example, the 1 month 90 strike put still trading for $1, but instead of buying it, you sell it. You collect that 1 month put for $1. Now we were talking about 10 contracts before on 1,000 shares, but we've also been talking about starting small. So we're going to dial it back here just to one contract. You just want to nibble a little bit. You want to get your feet wet in XYZ. If it continues to drop, you could always sell more puts, buy more stock down the road. So in this case, we're going to sell a one lot. Remember, $1 times 100 shares of the underlying. That's $100. So that's $100 in your hot little hands. Doesn't sound like much, but again, it's an income stream you did not have before. And now if the underlying stock expires at the end of that month below that 90 strike, you will buy the stock for the effective price of $89. Remember, you collected $1, so it's 90 minus 1, $89. And now this is not a free trade. It's not a free $100 that your broker, JJ isn't going to come to you at his brokerage house and say, okay, here you go. This is a free trade. There is an opportunity cost to this, which is your broker will now take the rest of the money, the $8,900 you need to buy that stock, 100 shares at the effective price of $89, and they will put that aside. So that is now your opportunity cost for this trade. And as you start looking at other names, other indexes, the prices will vary, the margin, all these things will vary depending on what you're looking at. But just know that this is not a completely free lunch trade. There is an opportunity cost to this on top of the actual risk. Obviously, if the underlying stock blows aggressively through 89, maybe it gets to 50, then you at least didn't do a lot. You kept things small, and that's another way to mitigate your risk. So Gary, I just wanted to put some definitions to what we're talking about here as we look at the results of this poll.
So just before we do that, and I'm going to make sure that the audience understands, let me translate a bit of what Mark was saying, which to me says you can get paid a premium for the opportunity to potentially buy a stock at a discount. I mean, at the end of the day, you want to have a clear benefit here. And what Mark is talking about is saying, hey, I've got my eye on this thing. I'd be willing to buy it for 10% below where it is now. And somebody's going to pay me for the right to sell me that stock at 10% less than it is today. I might just want to take that transaction.
That's a great way to put it. I agree with that because at the end of the day, we want people to come away from this with very straightforward, actionable things they could do. I think take nothing else away from this conversation. If they're comfortable working orders in a stock, an order to buy and an order to sell a stock, and I'm assuming everyone here is comfortable at least doing that, then they should be comfortable and they should be willing to do the strategies we're talking about here, which is, of course, sell the covered call to sell the stock and sell the put to buy the stock. Why? Because working orders in the market right now, that involves risk. Look how much we're whipsawing intraday now. There's real risk to just working an order in the market. You should be compensated for that. And that's what Gary's talking about. By using these techniques, by using options to get in and get out of the stock, now you're getting compensated at the very least for that risk you're taking.
Okay. So let's talk about the result of the poll. This is interesting. 60% of the respondents here said they straight out bought puts or calls. Only 1 out of 15 people who responded have used covered call strategies, which I'm surprised about.
That stuns me, quite frankly.
Yeah, two out of the group have sold puts, and 3 or 20% have done spread transactions. So people are taking a direction up or down in terms of what they do. And I don't, Mark, you'd suggested we run these questions. How does this color what you'd like to discuss?
It kind of surprises me. I also probably, if I had to speculate on these results, I mean, might imagine a lot of our listeners have come to options within the last year or two since the onset of the pandemic, because this is kind of the use case we've seen become most probable and most popular over the last couple of years, which is, of course, I mentioned last year, the meme stock palooza. Everyone was buying calls and just about every underlying under the sun. We've seen a lot of premium buying, which is not always the case. People usually come to options trying to generate a little bit of income, but these days, there is a lot more of the speculative, more premium buying type trades. So if I had to wager, I have to say a lot of our listeners probably have started trading in the last couple of years. I could be wrong, but I'm willing to wager that's the case.
Okay. Question for you, Dan, in terms of time. If somebody, anybody who's on this call has an interest in doing better or certainly making money and preserving capital through options trading, what kind of time commitment should somebody realistically make, and how should they be spending that time to educate themselves?
Gary, one of the things that I have observed from our more successful folks is to first kind of take a little bit of an assessment as to how will options fit into my life, right? You can't become a professional trader when you already have a full-time job, because that is a full-time job, right? But if we're using options to, as an investor, to enhance income, maybe to protect ourselves, just sort of using them as an overlay to already traditional conservative investing strategies, we don't need to be in front of our computer all day long to do that. We need maybe 2 hours of research on a Saturday and Monday morning putting on the trade. And I think if you're doing this as a self-directed trader / investor, you probably have some interest in it, and you'll check on it now and then. You might look at your phone while you're on the train to work. Okay, well, this covered call is working out just as I thought it would, and I'm gonna stick with my plan, right? Or this is going against me. This is where I set my plan to make some sort of change to this trade because it's done something that I didn't want it to do. So it doesn't have to take a lot of time, and it's not even really you get into it, you get out of it what you put into it, because you can really leverage your time quite a bit with options when you're trading with a plan, when you're trading with a solid objective. I think conservative investors, a couple hours a week.
That's great. JJ, within your platform, you offer a lot of resources. What do you find new traders, new options traders gravitate toward most, and how do you find that changes over time?
Gary, thanks. So, we have our Tastyworks brokerage platform and our Tasty Trade content platform. And the first thing I'll say is, with what Mark does all day, with what we're doing at Tasty, what Danny does on a more individualized basis, I think the greatest thing about the options world, so to speak, is you can find free, you can find pay for, you can find the thing that fits you from an education perspective, which is wonderful. And so what I would say is I think a lot of people, when they first start going to options, come to platforms like ours for content, or like Mark's, where they can get tons of free content. Those who really want to take it perhaps more seriously may get somebody like Danny to take them to the next level on a more individualized basis. But what we find primarily is, I think people, are, as I said earlier, are coming in with the look what I can make type mentality. And the first thing we try to sell them is, okay, let's really look at what you can make. Let's look at probabilities. I think people forget all options are giant probabilities. And as things change in time, the probabilities change in time. So, as I look right now on the platform, and I'll just talk about Apple for 1 second, only because I'm not recommending it, whatever, but I think people need to keep this kind of thing in mind. Even if you're never going to trade an option, I don't know that the folks listening realize that the volatility tells you how much a stock is going to move. If you buy Apple today, it closed tonight at $143 and base 39 cents. There is if you hold it from now until December, 57 calendar days from now through December expiration, the stock, a one standard deviation, an expected move is $19.03. I don't think a lot of people holding Apple actually take that into account, that it can go down to $124. In fact, there's an expected move on the downside. It can go to $124 on the downside. And then, of course, on the upside, it can go to $162. I think if you bought the stock, you're pretty darn comfortable with that $162, but you're probably not quite as comfortable with that, a downside $124. So I do think that just using the information there, we try to tell people, even if you're not going to trade options, use it for your stock trading. Options give you expected moves, probabilities of moves. And I think that's the most overlooked part of what options are giving to everyone in the market, even those who don't necessarily think that they're going to trade them. Obviously, we all believe in them. I've been fortunate. It's what I've done my entire life. But they tell you so much more. And the more you learn, the more you're like, wow, this is amazing, all the information contained here.
Well, it's an interesting thing that you talk about a very practical application of this data in looking at standard deviation and so on. But why do you think, in fact, why do any of you think that there's really a knowledge gap, that people are either concerned about this is too risky, they think it's too complex? Is the issue communications, or is there something else going on?
No, if I could just go one more time really quick. Think about what Mark did earlier on the example, and I think it shows that Mark is doing a great job of communicating this risk. He used a $100 stock. He used a $1 option. He used very easy to consume examples. One of the problems traditionally for the options industry is, I do think, we'll go back 10, 15 years, there were people who tried to keep it a mystery so they could sell you the education. I think the people now realize giving free information for those who are educators like Dan, it actually helps their business, because you're dealing with people who are more curious in something that's legitimate. And so I think you hit it on the head, Gary. Traditionally, many people didn't do this in a straightforward manner. And the other thing is, quite honestly, people don't love math. So when you start talking about standard deviations, et cetera, a lot of people are like, oh my God, this is going to be high school class, and their eyes roll up in their head. So keeping the example simple, as Mark just did, and it's practical, all of a sudden it's like, oh, you know what? There's something interesting here that I should learn more about.
I specifically avoided standard deviation, JJ, just for that reason.
I'm going to ask you, Mark and Dan, comment on this one too, but just one thing for the audience here. We've got about 20 minutes left. If you have any questions for the panel, this would be a great time to put them in the Q&A, and we can get that going. So as we wait for those to come in, Mark, let me ask you to answer the same thing in terms of what you feel the barriers to knowledge or communications are.
That's been the $1 million question ever since I got into this business, and certainly in the last 15 plus years that we've been running this network, is what is the hurdle? What is the barrier that is keeping people away? And I think the narrative has somewhat flipped. As I mentioned, in the last couple of years, we've seen this massive inrush and encroachment of new traders into the options market. And also, if you look at a lot of the broad financial media for years, for decades, it's always been very negative whenever options and derivatives were. That's the reason we don't call our site the Derivatives Insider. No one would go. It's a terrifying term, right? So derivatives have been tarred and feathered with this very, very pejorative brush, and options have fallen into that same bucket. We've had bears, all these, just you name the AIG, all these terrible Orange County going back, and just all bearings There's all the crazy ones that really have been just headline making disasters. And I think fast forward in the last few years, we've seen a flipping of that script. A lot of headlines have been about people starting to trade options more, a lot more options volume. What I mentioned at the top of the show, the explosion of options volume out there. Now, some of it has been highly speculative, let's say, particularly last year. And so that got some headlines as well. You know, the usual options are speculative. But I think in general, this barrier has started to really break down, where people in the past used to think of options as extremely intimidating, extremely complex, and extremely risky. They viewed them as risk additive versus risk mitigating. And now we live in a world where, you know, there's people talking about options on TikTok and crazy things like that. So it does seem like, especially in the last couple of years when everyone was stuck at home and they needed to develop new interests and new ways to manage their money, that it seems like options, they crossed that threshold. They crossed that barrier. We've had a guest on our network recently. They said everyone for years has wanted more people to come into the options market. We didn't know they were all going to come at once. And that's pretty much what we've had over the last couple of years, Gary. Everyone has come at once now. And it's been fascinating to see.
What you ask.
Exactly. Now we have to deal with that. It's a good problem to have, but it's fascinating nonetheless.
We've got some audience questions, and Dan, unless you need to add something on this one, I'm going to go to those.
Yeah, let's do it.
Okay, so I'll start with you then. Here's a good one. I want to invest between 100 and 300,000, and I want protection in case the market goes down an additional 10 to 20%. How would I estimate the cost for getting that protection with options?
Let me hit on something really quickly with that. A good ballpark rule of thumb, I'm assuming you mean broad market S&P index, a good baseline quiet market rule of thumb for you can use when you're thinking about, man, I want to buy protection, or maybe I want to go out a couple of months, let's say 5 or 10% out of the money type protection, and have to roll that every couple of months. A good ballpark figure, most of the studies for that come down somewhere around 8 to 9% per year. Now, that's obviously more than what your traditional equity averages in a year, somewhere around 7%. So that's expensive in and of itself. And now you're going to want to increase that because we are now in a high volatility environment. Things like volatility skew, which I won't get into today, are also causing those puts to cost more. So you're going to be well beyond the 8% per year that you're costing. So just use that as a baseline rule of thumb.
Dan, do you agree with the number? It's that ballpark that you'd buy?
Yeah, those numbers are, that's pretty ballpark. That's, Mark and I do a show together and we've talked about those exact figures. And, this kind of ties into what I was saying before about what you learn in a textbook, versus what happens in real life. In a textbook, you learn, hey, you can protect a stock that you own by simply buying a put, or buying, a put and then wait until it expires and buy another puts. And there's many techniques for buying puts taught in textbooks, but it's one of the worst ways when it's purely just put buying. It's one of the worst ways to protect your stock because it is so expensive. Mm-hmm. So when you end up doing this in practice, we need to take it just a little bit of a step further and add some other components to that to basically to pay for that put, which we can also do with options. We can do things like collars or what I call split time collars, where we're just using different expirations. And, for the folks who are newer to options, that might sound really intimidating at first, but at first maybe it is, but you eat the elephant one bite at a time, as they say. And it's really not that complex. And it is something that, again, professionals and regular folks who have investment accounts alike all do these same techniques.
So that segues into another question that somebody asked, which is, where do you go to learn the 101 course? And let's apply that question, JJ, if you want to take this. Let's apply that question to the prior question. I want to learn how to best protect my portfolio for this 8 or 9%. How do I go teach myself how to do this?
Sure. I'll do a quick sort of self-promotion. I think our Tasty Trade, tastytrade.com, our free network, is very good. I'll self-promote. I wrote a book a few years ago called Essential Option Strategies, which is a 101 on options. But I think here's what I will say also. And I said it earlier, Mark does a great job every day The exchanges have tons of education. The OIC, which is the Options Industry Council, has lots of education. The nice thing is, to get started, there are plenty of places that you can go for free. And as I said earlier, someone like Dan does this all day long for people too. So I think the nice thing about this, it won't be lack of information. It will actually be you deciding where you want to get started at, what suits your time and consumption needs. I think sometimes people forget their consumption needs. Is it going to be more from an audio type thing like Mark? Is it going to be more video like it is with Tasty Trade or some of the other things? Or is it going to be in a book, or going to be with Dan and somebody teaching you? So I think the first thing you may want to decide is, how do you learn best? How do you consume best? And you're going to be able to find plenty of content no matter what that way to do is. Very good.
Somebody asked a question that picked up on what you were discussing before on the standard deviation. Where do you find that data? The question was, where do I find the predicted volatility or standard deviation that I'm looking for?
Well, on our platform, Tastyworks, it's on there for every single stock, every single expiration, what the expected one standard deviation move is based on, the volatility. Because if someone comes up to you and says to you, oh, by the way, Apple has a volatility of, and here, let me see what the vol I was looking at a moment ago, has a volatility of 41.75. You're like, who cares? What does that even mean to me? But if I tell you Apple trading 143 is a 41.75 volatility in December, that means a plus or minus $19 move. Now it means something to you.
Yeah, now it's relatable.
So putting the volatilities to prices, we do it for you so you can see what that actually means.
Makes sense. I've got a use case question here. I'll read you the whole thing and I'll take a volunteer. Is there a way to buy a high dividend yielding stock and completely eliminate upside and downside risk on the stock using options? For example, selling in the money covered calls, using that income to buy a put and keep the high dividend with no risk.
Congratulations. You just discovered dividend arbitrage 101. Yes, this is something that's been done for many years, was done on the floor a lot. It's still done to a lesser degree now. The OCC, the Options Clearing Corp, has made some changes to make it a little bit more difficult to do these trades. But exactly what you're talking about, buying the underlying stock so you capture the dividend, and then you're going to talk about selling the synthetic, something we haven't talked about here, selling the call, buying the put. So now you've effectively synthetically sold away that underlying using options. And so, yes, you can capture that dividend. Unfortunately, there's no free lunch in the options world, and market makers know this. This is not a new phenomenon. So if you do this spread, and you're going to have to execute it on the retail bid and offer spread. So what you're going to end up paying in slippage is going to cost you more than the dividend there. But theoretically, yes, this can be done. A little bit more challenging these days on a retail account. You'd have to really work it, and using synthetics against the underlying is not exactly shall we say, a retail-friendly strategy. I don't know, maybe, JJ, maybe it's easier on your platform these days.
What do you mean by synthetics?
Okay, well, he's talking about buying the stock, and then he says here, selling calls, and then in the money-covered call, so his person knows what he's talking about, and then using that income to buy a put. So if you sell a call, that is now, I don't want to get we only have a few minutes left. I don't want to get too overwhelming. We're talking about Greeks now, which is also Dan's wheelhouse. But you're selling deltas. You're getting short there, and then also you're buying a put, which is also short. If you do that on the same strike, you've bought stock, you've sold a call, you bought a put on the same strike. So synthetically, you've bought the stock, so you own it. So he's right. You can capture that dividend. And then you've also sold away the risk of that stock by using options. So effectively, you have no directional risk at this point. And theoretically, you can capture that dividend. Practically, in the real world, the retail account, the transactions are going to cost you. They know this. They've priced this in. So theoretically, the answer is yes, Mr. Anonymous. Unfortunately, practically, this is a challenging thing to do for retail. But you're on the right track. You clearly studied some options, so it's a good question.
Well, if I could add one thing, I think it's even difficult to do as a professional, Gary. Professional market makers, they're not going to give this away, so to speak. They want to try and do it themselves. So the prices of the options will be as such. As Mark said, it can be done, but you're going to have to take a little bit of risk in between. So I've never in my life seen a risk-free trade, so to speak. There's always going to be some risk in something that you're doing. So, and if you found a risk-free trade, you sure as heck wouldn't tell anybody ever.
You're not going to promote it. That's right. I mean, one of the things I guess that makes this easier than it used to be is the transaction costs are so much less. But nonetheless, the same rules apply. Yep. So we've only got about 5 minutes to go. I wanted to ask you individually, based on what you all do, what strategies are you using this year that you didn't consider or didn't think were prudent a year ago? I'll just ask each of you to answer that and start with Dan on this one.
Well, Gary, I mean, for me, as the market changes, what I'm following changes. Like one of the things that I'm fairly known for is trading earnings. We have an earnings trading class, and right now it's earnings season. And so that's what I'm trading. All my other strategies are kind of, I'm focusing less on them. About 6 months and a year ago, I was focusing greatly on the meme stocks, on short squeezes. And we developed a short squeeze trade trigger system that was accompanied by a class. So, I mean, I won't just say, what am I doing now versus what I was doing in 2021, because I feel like, we could say, what were you doing 6 months ago that you're not doing now, and vice versa. And I'm always going to have a different answer. Because the market's always changing, the way that I trade is always changing. And I think especially for the more active traders, we're focused mainly on investing here. But for the more active traders, I think that's a really good tenet to live by. Change with the market.
Okay. One last question for you, Tim. This is more general. As people get into use of option strategies more, do you find that there are some people who give up the opportunity for longer term gains in the interest of short term orientation?
Well, I'll answer on that. I want to add one thing to Dan's, if you don't mind, first, Gary, really quick.
Please.
And that was hopefully a lesson for everyone on the call is you don't have to do this full time also. You can, and it's awesome, and it's the greatest thing in the world. But, as your life situations change, you may change. So for me personally, I was fortunate enough to take over as CEO in July. So my demands on my time changed pretty significantly. So with that, I trade a lot more calendar spreads, which don't need constant monitoring throughout the day. I can monitor them, probably every half hour. That's the beautiful beauty of mobile devices as compared to constantly being involved in a market. And so it fits into what's going on in my life. And I would, I think people sometimes feel like as life situations change, and everyone's does at points, there are times you have more time, there are times you have less time. And the beautiful thing about options is you can adjust to that, with that. And so, and I'm sorry, I just forgot the question you actually asked because I was so focused on answering.
And it was such a wonderful question too. The question had to do with short term versus.
Oh yeah, do people give up? Okay, so I think that the nice thing is, again, back to that all or none. If you have 300 shares of a stock, why do you have to write 3 calls? You can write one to enhance your return and let the other 200 shares go if you think, over time you want to own that stock. So I think that, again, one piece of advice I give to people in general, it's not an all or none game. Most professionals think in partials. I always joke, professionals think in partials. Maybe it's why their divorce rate is higher than the average. But, I also add my wife made her worst trade of her life 33 years ago. Nobody's letting her out. But all that said, I think that really thinking about balancing your portfolio is a better way to think about it. You don't have to be all short term. You don't have to be all long term. You can absolutely balance it in there.
Very good. Mark, anything to add on that one?
Sure. I'm just trying to type. There's some great questions floating around here. I'm trying to type some answers to people too, so we can try to get everybody here in, get their answers here in the time we have remaining. But yeah, there's a lot to touch on there. I agree with what Dan said. You have to kind of, when you talked about what strategies are we doing now versus what we did or didn't do a year ago. You have to kind of ebb and flow with the market. Last year I mentioned was all about upside. The S&P was rallying, the meme stocks were hot. So most of the trades we were looking at, most of the trades that were going up in the market, most of the trades that we were doing ourselves were upside biased. It was taking advantage of the volatility, the skew that people were baking into these calls to buy call verticals, buy one at the money, let's say sell one out of the money type call, or call butterflies, buying one, selling two, to take advantage of selling more of those out of the money options and then buying one farther out. Those types of trades. Fast forward to 2022, obviously upside not as much in favor these days right now. So a lot of those strategies, you can still use the same strategies, but now they flipped to the downside. We talked before about cash secured puts. That is one great way to and someone has asked questions along these lines in the chat here as well. That is one great way, as long as you do your homework and you identify a level where you're truthful with yourself. Don't lie to yourself. Are you truthful? Are you truly willing to buy the stock here? If you are, then you could sell a put there, set aside the cash, and you've done your due diligence. Your risk is limited to what you put aside for that put, and you can move on to the next trade. Butterflies, where we were talking about put spreads, those are also great ways now, if you are comfortable with these types of strategies, to take advantage of the inflated levels of volatility in these puts and being able to sell them, not just buy them here. Again, and we also had a question about earnings. There's so many great questions coming in here. I wish we could do this for 2 more hours, Gary.
Well, I think we've packed a lot into an hour, and I want to thank all of you, Dan, JJ, Mark, for participating. I want to thank the audience for being part of this. I just remind the audience that there'll be a quick evaluation that you'll get via the Zoom link at the end of this. I think you've got a pretty good sense coming out of this as to some of the places to get started. And I hope you've all found this valuable, and we've certainly enjoyed it. I just wish you happy and successful trading going forward. So thanks again for joining. Gents, always a pleasure.
Thanks, Gary.
Thanks,
Great.
Gary.
This was great. Hope everyone got some benefit from it. I know we all had fun doing it.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.